Press the bell icon on the YouTube app and never miss another update.
Friends, welcome to another video on your channel Profit in Equities. Now today we would be discussing about Reliance Securities top 5 picks for the year 2018. Now for those of you who are not aware, Reliance Securities is one of the premium brokerage firms in India. Now also friends, if you benefit by the videos that we put up on our channel, please do give us a thumbs up. Also subscribe to the channel so that we reach more people going forward. Now, the first company on the list is Apollo Tyres Limited, which is available at 268.25. Now the target projected here is 305, and this company is engaged in manufacturing and sale of automotive tires. The company's segments include India, Europe and others. The Indian segment includes manufacturing and sales operations through India, whereas the European segment includes manufacturing and sales operations through its plant at Netherlands along with its subsidiaries. Now, if you were to look at the one-year chart for the company, you would see that the company had been on an uptrend for the initial part of the year, but since then has been consolidating. The market cap of the company is 15,345.24 crores, which makes it a mid-cap stock. The EPS is 9.73, which translates into a price-earnings ratio of 27.57. Now, this is expensive compared to the industry PE of 21.77. The book value is 93.30, which translates into a price-to-book ratio of 2.88. The debt to equity is 0.6893, whereas the return on equity is 0.1037. Now the promoter holding here is a matter of concern and is a bit on the lower side at 39.28. Now Reliance Securities expects Apollo Tyres Limited's market share in radial tire segment to improve on the back up of capacity expansion to meet the rising demand. Further, ATL is expected to benefit immensely with the recent imposition of anti-dumping duty in Chinese TBR market. Looking ahead, with the likely pickup in utilization from Hungary unit and possible improvements in price, as no new capacity is coming up in the European region except for Korea-based Nexen, Reliance Security expects ATL's European operations to witness improvement, which would lead to a buy rating on the stock with a target price of Rs 305. Now, Federal Bank Limited is the second company on our list and is being presented with a target price of 150. The current market price is 108.50. Now, Federal Bank Limited is a banking company which operates through 4 segments: treasury, corporate or wholesale banking, retail banking, and other banking operations. Now, if you were to look at the one-year chart for the company, you would see that there was an uptrend for the initial half of the year, but since then has been consolidating. The market cap of the company is 21,334.97 crores, which means it's a borderline case between a mid cap and a large cap. The EPS is 4.76, which translates into a price earnings ratio of 22.79. Now, this is cheaper compared to the industry PE of 28.84. The book value is 45.72, which translates into a price to book ratio of 2.37. Now, the important fact why Reliance Securities thinks that this could be an outperformer going forward are they believe that Federal Bank will continue to deliver further improvement in operational performances led by improving loan book growth along with changing portfolio mix. The bank continues to witness moderation in SMA2 balance, which clearly suggests fresh slippages during first half of FY18 was more of a one-off event. Also, this company has delivered consistent growth in operating profit and loan book over the last few quarters, which shows that it has a greater resilience on asset quality front, with its gross and net NPAs remaining within the management's comfort zone in the second quarter of FY18. Also, the bank is gradually coming out of the scenario marked with higher provisioning and continued stress on asset quality for the last few quarters. Now, looking ahead, Reliance Securities expects the strong traction in earnings to continue owing to the robust growth in loan book, moderate credit cost and healthy margins. They reiterate their buy recommendation on the stock with a target price of 150. Now the third company on the list is Krishna Forgings Limited, which is available at 860.30 currently, and the target price here has been set at 975. Now Krishna Forgings Limited is engaged in the manufacturing of forgings, and the company is operating in the forgings and tours and travels segment. Now if you were to look at the one-year chart for the company, you will see that it's a beautifully uptrending stock with a lot of wealth that has been created here. The market cap of the company is 2803.85 crores, which means that the company is a mid-cap one. The EPS is 15.20, which translates into an expensive price to earnings ratio of 56.60. However, this is lower than the industry PE of 68.33, which means that this relatively is still cheap compared to its industry peers. The book value is 151.83, which translates into a price to book ratio of 5.67, which again is on the expensive side. The debt to equity is 0.9225, whereas the return on equity is 0.0399. Now the promoter holding here is also on the lower side at 44.35. Now the reason why Reliance Securities thinks that this could be an outperformer going forward is because Krishna Forgings Limited is the second largest forging company in India after Bharat Forge, with an aggregate capacity of 1,50,000 MT. Now this company has recently concluded its major expansion drive and is currently in the process of improving the utilization of the newly commissioned facility. Now, as India's economy is set to witness healthy growth on the back of reforms and visible improvements in global economy, Reliance Securities expects the demand for automotive parts to remain healthy, and hence the forging works should also do well going forward. Despite a sharp upsurge in the stock price during the last 6 months due to improving financials and healthy outlook, Reliance Securities believes that the stock will still trade at attractive valuations considering a massive discount of close to 50% in FY20 earnings against Bharat Forge Limited. Now also, as the healthy improvement in return ratios is comparable with that of Bharat Forge Limited, they expect the valuation gap to shrink in the ensuing period, which means that they are putting a buy recommendation on the stock with a target price of 975. Now the fourth company on the list is Caesarea Ceramics Limited, which is available at 729.30, and the target price here has been set at 851. Now, the Caesarea Ceramics Limited is a holding company which is engaged in the manufacturing and trading of ceramics, polished and glazed vitrified tiles. It also offers products including ceramic wall and floor tiles, polished vitrified tiles, glazed vitrified tiles, and sanitary ware and faucets. Now, if you were to look at the 1-year chart for the company, you would see that the stock has not done much for the year and largely has been consolidating. The market cap is 11,591.35 crores, which makes it a mid-cap one. The EPS is 16.23, which translates into a price to earnings ratio of 44.94. Now this is a bit more expensive compared to the industry PE of 39.65. The book value is 74.22, which translates into a price to book ratio of 9.83, which is very expensive. The promoter holding is 47.58, which is again a bit on the lower side. Now, if you were to see the reasons why this has been projected as one of the outperformers going forward, is Reliance Securities believes that it has a market share of close to 10% in the domestic ceramic tiles industry, including the unorganized players. Now, they believe that over the years, the company has laid a strong foundation for growth by focusing on creating a strong brand, new product introduction, increasing distribution footprint, and a higher share of JVs. Now, in their view, Caesarea is well placed to capitalize on the burgeoning opportunity in the tiles industry in the coming years. Caesarea Ceramics' own facility at Gailpur went on stream in September 17 to manufacture high-value ceramic floor tiles with a capacity of 3.5 MSM, taking on the total annual capacity of its units to 30.1 MSM. Now, they believe that with an expected EPS of 22.4, the stock currently trades at a reasonable price earnings multiple of 32.3 cross FY19 earnings. They maintain their buy recommendation on the stock with a target price of 851. Now the last company on the list is Asian Granito India Limited, which is available at 576.35. Now the target price here has been set at 701. Now Asian Granito India Limited is engaged in the business of manufacturing of tiles. The company offers tiles such as wall and ceramics and also marble and quartz. Now if you were to look at the 1-year chart for the company, it's a beautifully uptrending stock with a lot of wealth which has been created. The market cap is 1734.09 crores, which means that the company is still a small cap. The EPS is 10.33, which translates into a price to earnings ratio of 55.79. Now this is much more expensive compared to the industry PE of 39.65. The book value is 118.80, which translates into a price to book ratio of 4.85. The promoter holding here is on the lower side at 32.32. Now friends, the important fact is even Edelweiss has also suggested this stock as one of its top picks for the year 2018. Also, the reason why Reliance Securities considers it to be one of the top picks is this is the third largest listed tile player in India with a total manufacturing capacity of 32 MSM. Currently, the unorganized industry controls over half of the ceramic tile market in value terms and also 60% in volumes. Now, with the rollout of GST, there would be a complete audit trail of transactions post introduction of e-way bill with effect from Feb 18. This will make it extremely difficult for the unorganized players to evade tax, which in turn will benefit the large organized players like Caesarea, Somani and AGL. Now, also the recent reduction in GST to 18% from the initial rate of 28% should hasten the process of formalization of the sector. In their view, going forward, they expect AGL's growth momentum to accelerate further owing to the faster formalization of industry post GST rollout, increasing focus on premiumization, higher A&P spend and enhanced distribution footprint. Now, considering the visible improvements in growth trajectory coupled with the attractive valuations, they think that this could be a potential beneficiary going forward. Friends, this is all what we wanted to show you for today. Thanks for watching and we will see you with another video.